Hey, everybody, we are going to talk about some deep value, high dividend stocks today. Tyler Crowe is joining me. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get a message from the Motley Fool. They are sponsoring this video. It is the best way to support this work we're doing. Get the top 10 stocks to buy right now. Again, that is fool.com/Frankel. So, yeah, we're having a fun time here, Tyler. It's like, midnight where Tyler is, so we're just having a good time. We're going to talk about some dividend stocks we're watching, and one that really is, I would call my favorite deep value stock right now is General Motors. I know it's not, again, not a very popular one, but I feel like there's a lot of value to be had here. And they just announced they're increasing their quarterly dividend by 25%, and they announced a new $6 billion stock buyback program. Now, $6 billion is already a lot for a company with a roughly $48 billion market cap. It's well over 10% of the outstanding shares at today's valuation. They're going to do $2 billion of it this quarter. So at a $2 billion quarterly cadence, it's a pretty aggressive buyback. This is on top of $16 billion of repurchases they've made since late 2023. So just in like a year and a half, they've spent $16 billion on buybacks. They had a lot of cash on their balance sheet. So this will bring it to $22 billion in buybacks in a roughly 2-year period for a $48 billion company. That's pretty unheard of. GM's been very, very profitable. They continue to beat analyst expectations and get no love from the market for it. They're expecting, their electric vehicle businesses ramped up very impressively. They now have the number 2 U.S. market share in electric vehicles next to Tesla, which no one's going to overtake that anytime soon. But this is like having the number 2 e-commerce share next to Amazon. There's no shame in that. So, really impressive ramp up. The percentage of the U.S. vehicle market that is made of electric vehicles is still it's less than 10%. It's about 8% right now. That has steadily ramped up quarter after quarter for the past year or so. So there's a lot of things that could continue this momentum. I keep hearing that profits are going to go away. I know there's the tariff risk that could actually make profits erode a little bit. But their recent guidance, they're guiding for about between $11 and $12 in earnings per share this year. That makes the stock roughly 4.3 times forward earnings. So even with some margin compression, I'm totally okay with that. They're generating a ton of capital for buybacks. And management is doing everything they said they're going to do, which is really what I like about this stock. I like they pulled the brakes on Cruise. A lot of people are disappointed about that. I know one of our colleagues sold his GM shares in response to that. I think that's a mistake. I think that getting rid of that, $1 billion of cash flowing out the door every year to pursue a robo-taxi business, I think getting rid of that is a smart move and focus, because they're really good at just personal vehicle automation, like level 2, level 3 self-driving technology. So I'm happy to see them focus on that. And I just really like what this business is doing. I think it's really overlooked by the market for a few different reasons. I will be monitoring the tariff situation, but it's one that it's one of the largest positions in my portfolio. And now Tyler is going to talk about a stock that we did a video on not that long ago, but they just reported earnings, and we're getting some interesting developments from them. So go for it, Tyler.
Yeah, I think this may be the very first time that Easterly Government Properties, ticker DEA, ended up in the Wall Street Journal, like on a headline page. Easterly was quoted several times in a recent Wall Street Journal article that was talking about federal government accelerating its property strategy, which basically means there's a lot of owned property by the government, and they're looking to dispose of that. And there's also the consideration of terminating existing leases. So, which I've been struggling to understand a little bit. I mean, the Easterly Government's fourth quarter earnings were kind of just, they're exactly what you expect somebody who leases to government to be. It's modest growth. There wasn't a lot of portfolio growth because they're pretty leveraged right now. Issuing new debt is not very attractive, nor is selling a lot of stock. I know that they sold some, which is kind of how they've been doing things for a while. But it was pretty par for the course sort of quarter that, there was some positive reaction in the market because of it. But I keep coming back to this idea of the federal government tearing up leases and starting over, which in the Wall Street Journal article, the CEO of Easterly Government Properties was saying would be a positive, right? Because there's a lot of underutilized buildings in the federal government. There's a lot of really, really old buildings in the federal government that um, are coming to the end of their economic life without significant reinvestment, and investment in capital expenditures, investment, things like that is not exactly something that the federal government has been doing a lot of recently. They tend to just they've moved much more to the leasing and letting somebody else develop it for them, and doing it that model rather than bringing that all in house. It, you know, I think on paper, a lot of people could see that as a benefit to Easterly Government Properties, but at the same time, there's just this creepy feeling that says, well, if the government's willing to tear up leases, what stops them from tearing up some of Easterly Government Properties leases? They did a multi division. They canceled a lease in Buffalo, New York, not that long ago, and there's been several cuts at the Veterans Affairs Agency, and VA outpatient clinics is Easterly Government Properties' largest position in their portfolio. 27% of their annual lease income comes from VA outpatient facilities. So there's part, I think you could look at this from both ways. Like, it could be good. Maybe this is opportunistic for somebody like Easterly Government Properties to, resume ownership of some of the government buildings that are looking to get rid of, and then you can recapitalize them, develop them, make and lease them elsewhere. But there's also the possibility that the existing portfolio could see some significant transformation from torn up leases, and trying to eke out some efficiency there. The market doesn't seem to think that the tearing up any of Easterly's leases is a huge outcome, but this is a business that trades with a dividend yield of 9.4%. It hasn't grown its dividend in a long time, so it's very much you're not buying this business for growth right now. I think you're buying it for its yield, and not doing much else. I don't think it would be. I don't think there's a lot of growth in the cards for now. And anybody who's looking to invest in this business should basically, see that 9.4% dividend yield and just be happy with it, because I don't think there's a lot of growth or valuation uplift coming in this business.
Yeah, I agree. I'm kind of in wait and see mode myself. That dividend does provide some kind of a floor, but there are some ongoing risks. You're not getting a free 10% dividend yield right now, so keep that in mind. I'm going to post the link to the original video we did about DEA, so you can get a better feel for the company in the description of this video. And thanks for listening. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investments. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.